Let's learn about excess reserves in banking. Excess reserves are capital reserves held by a bank or financial institution above amounts required by regulators, creditors, or internal controls. For commercial banks, excess reserves are measured against standard reserve requirement ratios set by central banking authorities. These required reserve ratios set the minimum liquid deposits that must be in reserve at a bank. More is considered excess. Excess reserves may also be known as secondary reserves. Reserves are designed to be a safety buffer for banks, who might not anticipate the need for extra capital in their daily operations. The idea of excess reserves was created alongside an incentive called interest on excess reserves, in which the Federal Reserve paid banks interest on funds that exceeded reserve requirements. Financial institutions that carry excess reserves are thought to have an extra measure of safety in the event of sudden loan loss or significant cash withdrawals by customers. Reserves have been a part of banking in the U.S. since the 1800s. State laws, enacted after a real estate bubble and bad banking practices caused a crash in 1837, began requiring reserves. These requirements changed over time to deal with other financial industry and economic circumstances, eventually leading up to the monetary policies of the late 20th and early 21st centuries. The Financial Services Regulatory Relief Act of 2006 authorized the Federal Reserve to pay banks a rate of interest for the first time, leading to a record $2.7 trillion in excess reserves in August 2014 due to quantitative easing payouts after the Great Financial Crisis and the recession it caused. Many factors affected banks' use of excess reserves, including the interest paid on excess reserves and the need for banks to manage their reserves to maintain liquidity and cover short-term transactions. The Federal Reserve discontinued its reserve requirements in 2020, thus eliminating the concept of excess reserves. Required reserves are the amount of capital a nation's central bank makes depository institutions hold in reserve to meet liquidity requirements. Excess reserves are amounts above and beyond the required reserve set by the central bank. If the central bank pays interest, many banks will likely hold more excess reserves to offset the costs of having reserve capital. But there is an opportunity cost to consider. The question banks have to answer is if it is financially more beneficial to lend that money and generate interest income or to have it in reserve for liquidity purposes. If there is interest paid on reserves or excess reserves, it is a liability for the central bank because it owes money. Here are 3 key takeaways. 1. Excess reserves are funds a bank deposits and keeps at its nation's central bank beyond regulatory requirements. 2. The Federal Reserve discontinued reserve requirements in 2020, thus eliminating excess reserves. 3. Banks can voluntarily hold reserves at the Fed, which pays them interest in a program called Interest on Reserve Balances, IORB. Hope this would help. Thanks for watching.